Welcome to the Addition Financial webinar, Working to Death, How to Save for Retirement Now. Our speakers tonight, John Standen and Rob Mazer, are financial advisors sharing their expertise from Members Financial Services. Feel free to type your questions in the chat box and we will answer them throughout the presentation. And now I'll hand it over to John.
Hello, everyone. Thank you for joining us this evening. I'm sitting here with my partner, Rob Mazer.
Welcome.
We are looking forward to this for a long time, obviously. Rob and I are the financial advisors that partner with Addition Financial Credit Union to assist members with any one of their financial savings needs, from life insurance all the way to legacy planning, retirement, income in retirement, you name it. There's nothing too big or small that we can't handle to try to help people get where they need to be financially.
We do retirement?
I think so.
Oh. We should do a webinar on that.
We should.
Oh, okay.
Oh, wait. So going forward, what we're trying to do here is really tackle some questions you may have about it: when to start, how much to save, where do I put my money, how do I invest my money, so many different things. Rob?
Yeah, and I think really the biggest question that we always kind of get asked is, what's the best time to start, or what should I wait to do until I start? And of course, I think both of our answers to that always is
now.
Exactly.
Definitely now. So we figured we'd sort of get a touch base on the budgeting aspect of it, because bottom line, people don't plan to fail, they fail to plan. So the big thing, you want to have a plan together, and when you're doing a plan, it's like anything else. It's a see it, say it, write it. If it's not down on paper, it's not real. So the first thing you want to do is really get down with what your budget needs are, because how can you save without knowing what your budget is and what you're going to spend monthly?
Yes, the B word, the dreaded B word that none of us like, but we all need to do. And it is so important, because you don't necessarily want to start into a plan and then have to backtrack and go back again and stop doing something. Not that it really has a big ramification to you, but I think it's more from a psychological standpoint at that time that, when you stop it, you feel like it's something hasn't gone right.
No, exactly. So this is sort of stepping up, sort of budgeting 101. Where we're starting, basically you're revealing the waste of what money you really don't need to spend. There's a difference between needs and wants. We all have them. Believe me, I want them myself. But in the end, you really want to go ahead and obviously look at step 2, directing your priorities. You want to create the new habits, which takes 30 days to form a good or a bad habit, either way you go. And then step 4, obviously it's definitely going to reduce stress. When you know that you have a budget in place and you stick to that budget, in the cases of when you make more money, then you're able to even put more away. But in the case you make less, at that point, you might have already put some savings away to cover that, so you don't have to take money from other places.
Yeah, and I think that's the biggest thing, too, to kind of touch on what you just said there, is that it really identifies exactly what somebody needs in order to live on, so that whenever those things do happen, raises, you move into a new position and you've got some extra income coming in now, whatever it might be, that really helps you define what that excess is and how much you really can afford to save, and put away at that point in time.
Exactly. I think the one thing that we all need to realize is the most important bill we all have is ourselves. You have to pay yourself first, and that's part into retirement. So,
yeah, and as this slide kind of talks about, it's allowing that flexibility in there too. Like we talked about, making it livable, you don't want this to be something that everything has to possibly go right, because we all know that doesn't happen. Things break, stuff happens, life gets in the way. So you have to be able to be flexible with it. It has to be something where you're not budgeting out to the penny. I mean, there are some people that can do that. I'm not one of them. That's not how my budget goes.
That's not fun.
But you do want to have some buffer zone in there, so that whenever life does happen, that you're not just completely chunking it all away and stopping it and kind of like doing that whole thing where you say, that was a waste of time, right, and not going back to it again.
Well, I think you said a very important word right there: realistic. Realistic is still doing some of the things you want to do within reason. Again, a budget has to be real. If it's not, you will break the budget. The budget won't work for you. So you just want to be honest.
Yeah. And so, when you're looking at that, kind of looking at, the first place to start, where do you spend your money now? And again, that can be kind of a depressing exercise sometimes whenever you realize exactly how much money you do spend at the McDonald's drive-thru every day, how much, Starbucks, does take a cut from your wallet. But that's really the first place to go to is being able to look and track your activity, going back historically, and with that you don't have to go back over the entire year.
Exactly.
I think, if you go over a couple months worth, you get a pretty good idea where you're spending money at.
Yeah, I mean, there's some apps out there that'll actually help you track that, where you can categorize it, and by doing that, you'll actually get an honest number. I mean, to be honest, I'm lucky enough to have a account where it sort of has that option built in. I tracked it 1 month, thinking that I might not spend more than $500-600 a month on entertainment, and everything I put in the entertainment category that following month when I tracked it, it ended up being 3 times that. I couldn't believe it. Yeah. So I definitely stepped it back to $600-700. I didn't want to like sort of bite all the bullet at that point. But that's from going out to eat, movies, things like that. I think it definitely helps make things, again, the key word here that Rob said earlier was realistic.
Yeah. And so, when you're kind of looking at it and you're setting your goals, and obviously we've all heard of SMART goals, the specific, measurable, attainable, realistic, and timely. But from that point, then you really want to set it out and say, okay, where are you trying to get to? You talked about the failing to plan and planning to fail, that whole thing. You've got to kind of layer these goals in here, and it's, you're not necessarily going to be able to tackle them all at one time. And, but if you can do a little bit for each of them, I think that's a good strategy to use going forward then. And when looking at it, when you talk about kind of time frames, we talk about emergency funds, and I know that we both, I know that we're out in our branches, we kind of set the expectation of about 5 months worth of expenses, from a financial planning, the CFP board. I think that they've always recommended 3 to 6 months worth of expenses. So 5 is a good number. So that's kind of your first, one of your first goals that you want to look at there before you start going out and trying to do anything too crazy.
Definitely, yeah, that's the basic. I mean, the bottom line, you have to have money to cover emergencies, because if you took that money and invested it, and you weren't able to get to it, or you had to pay a penalty to get to it, and something were to happen, then you really are going to get hurt that way. And we don't want to see that happen, because we just want you to have a good experience with investing by doing that. Saving first is probably the most important key. Once we're there, it definitely gives you some other options going forward.
Yep. Absolutely. And then when you start to look at those things, then you start kind of matching up, kind of your returns and the different ways that you go about that. Where do you put some things, and looking at it, we talk about savings. Your emergency fund is obviously money that you want somewhere where it's readily accessible, somewhere in the credit union, whether it be a checking account, a savings account, a money market account, a CD or shorter term CD, something along that line. That's matching up a short-term product with a short-term need. And that's one of the things I always stress with my clients, a lot, is that different products have different kind of time expectations to them, and that's how you want to use them appropriately. And having all your retirement money into a CD, that's your long-term money in a short-term product. You've got a mismatch there. In the same way, if you have your short-term money and you're trying to throw it into the stock market, especially with some of the volatility that we've seen this week, that can be a pretty not a wise approach.
Detrimental, absolutely. No, you hit the nail right on the head with that. I think the big thing is also having a clear picture of the direction you want to go. That being said, that's another reason why you'd sit down with a professional and have that conversation, which Rob and I definitely do with no obligation.
And so I think this is probably a good point. Why don't we go ahead and throw it out there for a question right now? Our first survey question is going to be, in 2018, a Millennials and Money survey, asking how many said they're actively saving for retirement.
What do you think that is?
Well, I have the answer. So.
Oh, okay. We didn't tell them that.
However, I will say that even having the answer, I was actually kind of surprised by it.
I was as well.
And actually, I was surprised it was actually a little bit higher than what I had expected.
Me too, I think.
Yeah. So it's about 83% of the audience says 6%. It's actually 31.
I would have said 6 myself without seeing the answer.
Yeah, I would have too. And that goes into it. That generational kind of savings patterns. I think we've seen that bear out a lot more. I know as far as the members that I see that come through, there's been some very impressive ones in that age range that really kind of have their things straight.
Well, they say that your savings habits or investment habits usually come either from your parents or your grandparents as far as influence. So that being said, that looking at that answer, it's a little scary. Again, it's like being that person afraid to ask the question to the teacher in college because you don't want to look silly in front of your friends because you don't understand the concept. But in the end, by asking that questions, not only are you going to clarify it for yourself or get the answer that would help you succeed, but you're also going to help out 6 other people that were afraid to ask that same question. So
yeah. And so to kind of then tie into this, as we're talking about kind of the millennial, the what is it, Gen Z or Gen Y or whatever.
I don't know what gen we're on, but it's down there.
I'm Gen X, so I'm smack dab in the middle of everything.
I don't think it's alphabets anymore. We're gone on to something else.
But this is, and I love this this example. This is one that I think I actually referenced in the podcast. Yep. Going back through it, and in this example, we've got Ben who invests $2,000 a year every year from age 19 to age 26, and then stops. And in both these cases, they're both assuming a 12% rate of return here. And then we have Arthur, which I think is probably the much more typical kind of example. Arthur starts at age 27, invests every year at $2,000 a year, every year after that through age 65. So kind of that retirement age. And the answer really is kind of shocking in terms of what the result is.
Now, again, it's just one of those things that shows that starting early and compounding returns and interest of what it can really do to a portfolio.
Yeah. And so, if we kind of see what it looks like here graphically. So, old Ben there, we've got 1, 2, 3, 4, what is it? 10 years. Is that right? If my public school education is correct. So, $20,000 invested, from Ben's standpoint, and Arthur's putting in a lot more than that. Looking at what the returns look like then, so I'm sorry, it's actually $16,000. I can't count. So
8 years.
Whoopsie. So thinking about what that money grows to, and this is, the old Ben Franklin, the 8th wonder of the world is compound interest, is, at age 65, Ben has, almost $2.3 million from that original $16,000 investment. Whereas Arthur, after having invested for 39 years, so putting almost $80,000 of principal in there, almost 4 times as much out of pocket as what Ben did, has $1.5 million, almost $1.3 million left. Or, I'm sorry, I really can't do math today, can I?
No, $800,000 left. Well, it's funny because if you look at this, I think that answer on the first one is going to go from 31% to 52%. So,
yeah, and I think we have a question about where you can get a 12% rate of return. Call John or I. No.
Yeah, we have some places for that.
No, 12%. That's it's really kind of more a hypothetical, obviously. Whenever we set return expectations with clients.
We'll give you an idea. If you were to look at the whole life of the Dow, the stock market itself, on average returns 11.5% a year. So that's if you're in the stock market all the way.
Right.
So that being said, there you go with your 12%. But hey, I like it too. The unicorn is nice.
I know. Yeah, this is like I said, it's definitely a hypothetical.
Yes.
So kind of moving on. So after we've kind of talked about now, starting early and getting that budget down and kind of really kind of defining exactly what we've got to work with here. Now we're looking. We dug kind of into our budget and looked at it a little bit. We look at in steps 2 and 3, determining your income. Obviously, look at what you regularly bring home. You don't want to include if you got a bonus in there. Now, obviously, if you get an annual bonus that's pretty dependable, you can kind of budget around that. But, if you're somebody who works on commission or, something along that line, you want to use a much more conservative estimate there.
Well, the bonus, if you're really planning for your future, should go to your savings and then investments.
Yeah. And that's a good way to jumpstart it too. I mean,
Absolutely.
Really, if you think about it.
It just gives you another option because obviously most employers will offer the retirement plans internally, and having another place to go with those funds is always good.
Yeah. And then when we talk about, kind of determining your expenses, you're fixed, you're flexible, you're discretionary. Yep. Obviously, you're fixed. Or things like your rent, your mortgage payments, car payments, things like that. Your flexible ones are things that you have to have, but the amount might not always be the same.
Right.
Your utility bills, things like that. Discretionary, That's everything else, that's out there. Been, like we said before, sometimes those wants become needs there. And you kind of look at those things, things that you can really start to spend some money on.
And those are the budget busters, as you can see here. That's what it looks like.
Yeah, and it's funny because you look through this, and I know, just like you were talking about before, about looking across different accounts and knowing how much you spent. I can say the one upshot where I've had some fraud on my debit card, several times. The only good thing that's really ever come out of ever having fraud on my debit card is that it's canceled out some of those auto payments that are coming out of my account. And so it's
forced your hand. Sometimes that's what people need right there.
It's that negative election thing.
Yes.
That, and I get teased sometimes about being the king of the free trial. And sometimes you miss canceling those free trials, and then, whoopsie, where'd that $50 go to?
Well, then the brother or sister company gets you on for something else, another free trial, and they get the same thing. So next thing you know, you're paying $500 to the same company. It's pretty funny.
So you look at that, and the ways that you can spend some extra money, and really kind of, going through, and, you're not saying this is the beans and rice and beans, kind of thing here. I mean, what we're talking about, these are truly the kind of the want items, and within a budget.
Yep. Yeah. And that being said, I mean, these sort of give you a breakdown or a guideline to follow. It might not be verbatim for everybody. Everyone has different, needs, wants, the things that are more important to themselves. That being said, this just gives you an idea of a rough breakdown of what it could be. So essentials, things that you need, 50% of those after-tax dollars are going to the necessities, things you need. Lifestyle-wise, we're looking at 30%. Those are your wants. And then savings, hypothetically, should be 20%.
Yeah.
My grandfather always told me it was 10. The tithing, you pay yourself like you pay God. But hey, it's one of those things where every person sort of has to be their own keeper.
Yeah, and that 20 in there too, that does include some debt repayment. Yep. So that's, again, not being unrealistic that, there's going to be things like student loans, the quote unquote kind of good kind of debts that are out there sometimes for people, that, you have to get those things repaid. Not that they're not essential, because, the student loan, it's the only type of loan out there that's not dischargeable in bankruptcy, or one of the few, should say it's not dischargeable in bankruptcy. You can't get rid of it. Only way to get rid of it and not pay it is to die. So those things are till death do us part, type of a thing there. But you're looking at savings and debt repayment, that 20%, kind of gives you a little bit of wiggle room within there.
So again, like we talked about before, the importance of number one is the emergency fund. Without that, you really shouldn't be moving forward. A lot of people, believe me, we run into a lot of clients a lot of times that would like to invest funds from there. And we get paid to do those things, but to do what's right for our membership, we definitely tell them that that's the most important thing, to keep the emergency funds where they are. Number two, obviously the 401k contribution. That's your employer if you're working. If you're not working, you could always go ahead and contribute to an IRA for yourself, to go ahead and start a retirement plan until you eventually maybe get with a company that does offer it. Three, your savings goals, things that you are trying to save up for, whether it be buying a house, buying a car, things like that, pretty important. And of course, number four, debt repayment. That's an important one, because let's face it, there's a lot of people that are retired, no longer working, but still have debt. And in a sense, since you still owe payments to a credit card company or these debt companies, you're really not retired in a sense. You're sort of working for them at this point.
Yeah. So along that line, and you saw back, we had 401k contribution is really the kind of the second thing on that list. And it's, why would you do that? Well, because in many cases, your 401k has a match provision to it, whether it's dollar for dollar or 50 cents on the dollar or 25 cents on the dollar, whatever it is. Why do you want to go ahead and do that? Why would you put money into your 401k in that case?
This screen right here says it all. It's free money. By not going in and contributing the money, say your company matches 5% and you put nothing in, they're not going to give anything. There are very few companies that might give it regardless, because that's just a good company. But I'd say probably 90% of them require you to go ahead and put the same match in to get up to what they match. So if you're not putting in 5%, you don't receive that free 5%. So you're actually doubling your money without even doing anything. Yeah,
I mean, it's if you think about it in terms of return on invested dollars, if you have a dollar for dollar match, that's 100% return on your money. If you have a 25 cent match per dollar, going back to our earlier, question from the audience of where you can get a 12% rate of return. Well, in your 401k is a great place to do that right there by itself.
Perfect.
Because your money's going in, you're automatically getting a return on it. And that's without putting it into the market. That's without investing it. That's without doing anything for it whatsoever. That's allowing you to do that. So before we go, actually, we have another question, from the audience, and this one is, my career was on hold for 5 years during the recession. Recently gone back to work with a 401k and Roth. I've tapped out my contributions. How screwed am I?
Well, you're not screwed because you can obviously do investing on the outside with non-qualified money. So the difference between obviously a 401k or 403b IRA funds that's considered qualified, you can take money out of savings if you have excess there, as long as it's not tapping into your emergency funds, and invest that for yourself and have some long-term capital gains, which more so are fixed. It's not so much driven by the income. Yep.
And this time, I think it's probably a good chance to kind of pause again and let's poll the audience again.
Sure.
So, second question, since we've just been talking about 401ks and putting money into them. So next question is, if you withdraw money from a 401k before 59.5, what's the tax penalty that you pay? And again, this one I knew. I knew this one too. So pat ourselves on the back on that one.
Yeah, well, I won't hurt myself too bad.
I know. So you got to strain it. Do some stretching.
All right, here, I'll get you. You get me. We're good. We're good to go, Rob.
So, and again, 81% this time, again, favors the 10%.
10%, and that is the correct answer.
Yep. So 10%, that's the 10%. Now, that's the penalty tax.
Correct.
So don't forget about that. So
it counts as income. So when you pull, that's just the penalty you have to pay to the government. You also, whatever you're claiming that year in taxes, whatever your tax bracket would be, you'd also want to have that held as well.
So again, that's why when we talk about, kind of setting up that emergency fund first, and then moving to the 401k contributions second, that's why we want to do that. We don't want to put money into the 401k that we might need to access, because there is that 10% penalty tax that we can incur there. And so we want to avoid, we want to pay Uncle Sam the fair share, but we don't want to pay more than our fair share, I guess. Exactly. Is probably a good way to put that. So, so we talked a little bit about 401ks. And let's talk now and kind of transition a little bit into the different types of IRAs. And IRA obviously standing for Individual Retirement Arrangement. I think is the official IRS version, or individual retirement account. You'll hear that one as well. And the traditional and the Roth IRA, those types of options are typically available inside of a 401k. So for our discussion here, we can kind of talk about those things. And then you've got some of the different IRAs out there that are probably less prevalent that you hear about.
Yeah, the spousal IRA, for those who might not be aware, is if you have somebody who's husband or wife staying at home raising the child and the other person's the breadwinner, it's what they call a spousal IRA that you can do. You can contribute as long as you have their earned income up to the full amount of whatever's allowed. Anybody under 50 can do up to $6,000. Anybody over 50 can do $7,000. So if your spouse is the homemaker and they don't work at all and have no earned income, as long as you have earned income to cover both, you can actually make that contribution for your spouse.
Yeah, and it goes way back.
It does.
It's been in practice for a while. It's kind of gotten out of vote. I haven't seen as much lately.
I haven't either.
But because you have the prevalence.
More people working.
Yeah, I mean the prevalence of the 2-income family now. Yep. But in those cases where you do have that, that's where there is value to the one who works inside the home, and so that the government does actually provide for that.
Yeah, they want to make sure they have the ability to also grow some funds in retirement as well, which is great. This obviously rollover IRAs, that would be if you had an old retirement plan, 401k, 403b, something like that you thought you wanted to move from the current custodian. Excuse me, you have the option to go ahead and roll it over into an IRA. If you do a traditional, there is no taxable consequence. If you do a Roth, there's a Roth conversion where you have to claim all that as income that year. So you have a preference where you think you want to go with that. That's definitely an option that is available to everyone.
Yeah, and I kind of want to talk with members about that. Yeah. With the rollover side of why to do it, and obviously we want to look at fees, and fees are important. However, you look at the ability to customize within an IRA. Whereas your employer retirement account has 20, 25 options.
Yeah, the good plans have about 20 to 25. Yeah.
When you look at an IRA account, your options are thousands. So there's a lot of different ways that you can go there, and it's a lot more customized approach.
Yeah, the 401k is definitely more so hit at a large level of the base that they represent, which would be everybody that's employed by the company. So if you work for a large company, a large firm that say has 25,000 employees, you're one of the 25,000 that they're representing. You're not an individual that they're representing. So definitely, IRAs definitely enable you to tailor a plan maybe that would fit your needs specifically, which sometimes could be better.
Sorry, my daughter just chimed in and told me hello here, so I'm sorry, I was less laughing there. But, and so then the last type of IRA, and this one actually is becoming a lot more. I'm seeing more of these now as far as inherited IRAs, and that's because you think about when IRAs really kind of started and came into existence. Now you're starting to see more balances that are being passed on to from not just husband and wife, obviously, because that usually don't have that case, but from the second of mom and dad, whenever they pass away, they're passing on IRAs now to the kids and grandkids. So we're seeing a lot more in the inherited space there.
Definitely.
So with that, let's actually kind of move on. We kind of covered what is an IRA already. Let's kind of skip ahead here to the, and we were just talking about when IRAs came into existence and looking at, the differences between a traditional and a Roth. I think that's one of the biggest questions I get a lot is, what is it? What's this Roth thing I've heard about?
A lot of people sometimes too think that an IRA is the actual investment when it really is just the vehicle. Once you get that vehicle, it's empty. You get to load it with whatever you want. So think about it that way. Traditional IRAs really give you the tax break. So when you have the traditional IRA, if you're not rolling something in, it's something you're starting yourself. You actually have a tax write-off that you could use each year for contributing to that IRA. The Roth doesn't give you that tax write-off because the biggest difference with that is they're after-tax money, but it has tax-free gains going forward after retirement age. So it's one of the things where where you think you might end up. I like playing both sides of the fence. Some people think they'll be in a lower tax bracket when they retire, so they stick with the traditional. Some people think they might be in a higher one, so they prefer the Roth. There used to be a benefit to the Roth over the traditional where you could still contribute after 70 if you still worked and had earned income. But now with the new Secure Act that just passed January 1st, 2019, went into law, the traditional has the same capabilities now. So.
Yeah, and really to kind of drive home that point, I mean, the big difference here is whenever the money's taken out to be spent.
Yeah.
The traditional, everything that you're taking out for the most part from a traditional is going to be taxed. Everything that you're taking out from a Roth is going to be tax-free.
Yep.
And so that's kind of the difference. And so we actually have another question that kind of ties into this and going back a little bit to the company match. And it says that if my company match is at 4%, but I'm putting in 9%, is it better to contribute that excess 5% to a Roth?
Again, it's per case study. If you think that I would say yes. For myself, I would do it. I think a Roth is a really good play on what you already have with the traditional. You could always max out your contribution. And when you do that, it's not like you could do max out both. You can only have the option to max out the one. And I think it's $19,500 a year or 25% of income, whatever's less. Right. That being said, if you're over 50, you can actually make catch-up contributions of additional $6,500. That'd be $27,000, right?
$26,000,
right? That being said, going forward with that, I think a Roth is a good play just to play both sides of the fence.
Yeah, and I will say too, another thing that I kind of coach with my clients on is if you put your money in as a Roth, and usually typically the employer match comes in as pre-tax or as traditional, that's kind of a way right there in and of itself to get kind of the best of both worlds.
Absolutely.
Because employers, when you're there, they're just matching on your contribution. It doesn't matter if you're putting it in pre-tax or Roth. So, like I said, going back earlier, to reiterate, make sure you max out that match. But like I said, even in most cases, I would say put your money in as Roth, let their money come in as pre-tax.
I agree.
And that's a good way to kind of get an instantly have a little bit of both there and play both sides of that fence. So kind of moving on. Yeah, that was a great question. I like that one. Looking at, and so this slide actually a little dated, but fortunately the numbers are still the same. We don't have the 2020 limit on there. The 2020 limit is the same as the 2019 limit. And I think you touched on that earlier, John.
Yep.
If you're under 50, you can put $6,000 into a IRA. You can make an additional $1,000 catch-up contribution if you're over 50. And keeping in mind that that's $6,000 or $7,000 combined. So you can't do $6,000 to a traditional and $6,000 to a Roth.
Come on, Rob.
Yes, I know.
There he goes, giving the bad news again.
Well, you can do it until the government catches up with you, but it's not a sound strategy to recommend there.
No, probably not. I don't think we'd be keeping our job too long.
Yeah. So when we're kind of looking at it, in talking about traditional IRAs, and you're delving a little bit more into that. And another thing that compliance has to update us on our slides here is that second point there, the under 70 and a half. And I think you touched on that before, John.
Yeah, there is no age limit anymore on that. Like I said, the Secure Act was just passed into law beginning of this year, which allows you to make contributions as long as you have earned income to a traditional or a Roth at this point. It used to only be a Roth, but now it's a traditional as well. They've also increased, we'll probably touch base on another slide, but the required minimum distribution used to be 70 and a half as well. They've now stretched that out to 72.
Yep, perfect. And kind of looking at then, what is earned income? We talked about that. You talked about that before when we talk about the limits and the limitations on things. And your earned income is basically anything I usually describe as anything earned from work. Yep. The one really kind of exception to that being alimony, and even that's one I would say we need to sit down and talk to somebody before we get into that, because with alimony having changed,
there's a lot of outlines on that, because alimony sometimes isn't forever; it's for a set term, and that will have an effect on going forward with the plan.
Well, and the taxation of it changed too, so that's one we have to be very careful about. But things that don't count as earned income are things that when you get income where you haven't really had to work, or you're not doing work for it at this point in time. If you have pensions or dividends or interest or investment income, unemployment doesn't count. Obviously child support, that doesn't count as earned income. If it's not taxed, or if it's taxed at a preferential rate, I guess is a good way to put it, usually doesn't count as earned income for purposes of making contributions to retirement plans. Actually, we have a couple questions here that have come in. So we have one. It's I'm 62. I have a 401k. At what age is it worth opening a Roth?
Wow. Well, if you're still working, I'd say maybe start now. No better time than the present, since you already have the other bases covered probably up to that age. But that being said, again, it totally depends on how you feel about it yourself. I think getting the information on what it is and how it would benefit you would be the first step that you'd want to do.
Yeah, I don't think that there's ever a bad time
Absolutely.
To do it. I mean, I think that, obviously recognizing that, 62, depending on how many more years of work you have, you may not have as big a balance in that as you would on the pre-tax side, but still having options is always a good thing.
Definitely.
And another question we have is an IRA, would it be separate from a 403B?
Yes, an IRA is definitely separate from a 403B. 403B is similar to what a 401k is or a 457B, depending on what companies or style you work for, whether it be state, governmental, things like that. So the IRA really is something you'd open up separate from that. Or if you retired and no longer an active employee, you have the opportunity to do a direct rollover into an IRA, and at that point, become an IRA.
Yep. Another question we have, do we offer self-employed retirement accounts?
We absolutely do.
Yes.
That is an option I think is a lot of people miss out on. I do have a lot of self-employed individuals that don't realize there's something more than just IRA contributions. You can actually start your own retirement plan, even if you only have 2 employees, to be able to go ahead and put more of a max benefit to yourself. That's the whole point of it. That's you as the owner of the company, you're allowing your employees not only to save for retirement, but now you've opened up the door to where you can put more money away as well.
Yeah, I mean, you can do it on a pretty cost-favored basis.
Absolutely.
I mean, through what's called a SEP IRA or a simplified employee pension IRA. There's the simple IRA, a simple 401k, all designed for the small, less than 100 employee type of companies. Not as much administrative burden as going out and doing a full-blown 401k, but still have some much higher limits to them than what you're going to see in other places.
Absolutely.
Kind of moving on a little bit and looking here as far as deductible contributions. We talked about, obviously it depends on 3 things: your filing status, if you're participating in an employer plan, and your modified adjusted gross income or adjusted gross income, and kind of looking at it. I think if we kind of move on to the next slide here, and this is really kind of talking about, that what's the difference between doing a traditional versus doing a Roth, and what, from a tax standpoint,
right,
what the benefit is. And there's a lot of studies on this, and I don't know what your thoughts are, John. We can kind of talk about it, but many of the studies that you see that talk about comparing a traditional versus the Roth always assume that the participant takes and reinvests that tax savings. How many people in your career have you had that actually do that?
Unfortunately, you think about this. If I don't carry cash too often, but when I do, I can't keep track of where it goes. That's why I don't carry cash often anymore. So I think it's one of those things where if you leave the money in the pocket, it usually gets spent. Unless, again, you have that plan and you really do have a budget in force, and that money does go into savings, or money does go someplace where it could actually do better for yourself. But yeah, usually if you don't put it into something, you usually lose it. It's usually not put into savings.
Yeah, which is why, I think for most cases, when we're talking about kind of contributory IRAs, which is why we tend to favor the Roth IRA, for making that recommendation. And looking at this slide, and again, this slide, obviously we talked about the income limitations, the same as before. You have to have earned income. And yes, if you still work, you can continue to make contributions to this. And like John, to allude back to your point, it's the same for both of them now.
Yep.
So go ahead and moving on to the next. And so actually we have a question here from the floor again. It's, can I max out the Roth and contribute to an employer 401k?
Absolutely.
You can. However, keep in mind that there is some income limitations on having a Roth
on the
IRA.
Roth side, yeah. So this slide right here definitely represents that aspect of it. You are put into where if you make too much money, they're not going to let you put that extra away, because obviously it's one of the things where money sort of has to stay in motion as well. And they want to make sure everybody sort of has that fair opportunity to be able to earn and save for retirement. Yeah. So these sort of break down the levels here. In single active, you can see anybody who makes more than $137,000 cannot contribute.
Right.
Between 122, 137, again, partial contributions, and a full contribution, which is the numbers we had given you, the 6,000 or 7,000, depending under or over 50, would be less than 122,000 as a single individual.
Yeah, and looking at a married couple, as a couple, if you're below $193,000, you still qualify for a Roth IRA. Yep. Now, this is for a Roth IRA, not the Roth 401k or Roth 403b, if that option is available. Exactly. And so that's why, again, we kind of definitely steer towards looking at within that plan, both from administrative simplicity, but then also from the deductibility, not deductibility, but the contributory standpoint.
Absolutely.
The Roth 401k sometimes has a little bit more of an advantage there for most people. I have another question from the floor. It's asking, is there a minimum deposit to open an IRA?
There is not.
No, I mean, not really. I mean, you have some, abilities out there that you can do, if you can make $25, $50 a month.
Yeah, the initial part, you can do it where it's a sort of pre-deductibles, where you're just taking it out yourself or having it come out automatically, ACH into an IRA account, whether it be $5 a week or whatever it might be, as long as you don't go over the limits.
Yeah, I mean, we have the limitation on the upside, but there's really no limitation on the downside there. And to tie into that, we have another question that, can you invest less than $1,000 to start?
You can.
Yeah, I mean, absolutely. It's it's that going back to that, there's never a bad time to start all this. Now, might you be limited in terms of some of your options less than $1,000? Yes. Would you want to steer towards something that's probably going to give you some more diversification, like a mutual fund or an exchange traded fund or something like that? Yes.
Well, I think the one thing you sort of have to ask yourself too is be realistic. If you're expecting that $1,000 to be $10,000 in a couple of years, it doesn't quite work that way. Investment wise, we're a pretty conservative firm ourselves, because credit unions are conservative. So you have to sort of be realistic with that too. What type of return you get is sort of how much risk you're comfortable taking. And again, keep in mind with investing, in most cases, there's no guarantees.
So we have another question. This one's actually kind of a fun one. Two-parter. So, is a cash inheritance taxable? And am I able to put all of this into some form of retirement account?
If the cash inheritance is coming from life insurance, no, it's not taxable. Life insurance is tax-free. If the inheritance is coming from monies that are coming from the sale of a home, if it's coming from an IRA, inherited IRA that way, something like that, then yes, there's definitely some tax.
Yeah, an inherited IRA. Yeah, there's going to be some tax consequences there.
Yep.
Money coming. However, if it's say, if mom owned 10,000 shares of IBM, and after it passes to you, in that case, any gain that mom had up until that point would not be taxed.
Exactly.
If it passed you at death. So
I think they figured based off the value of death.
Yes, there's the date of death there that you get what's called a step up in cost basis. So in a lot of cases, no, that it's not going to be taxable.
Not all the time.
Yeah. Then as far as being able to use those to fund some form of retirement account,
yes,
absolutely. So here's another question from the floor. Is 18 the earliest age that you can start contributing to an IRA?
No, earned income that you're making at age 16 or up, I believe you can contribute to an IRA.
Yeah, it's really, I think, as long as you have earned income at this point in time, keeping in mind that most, my kids didn't start working and earning income before they were 16. So,
well, you don't want them filing taxes at 14, so just be careful.
That's right.
Those tax returns are always fun to get back.
For the most part, I mean, you can start well before 18 at that point. In fact, again, going way back to the beginning, what we were talking about, the earlier you start, the better off you're going to be in the whole thing. So that being said, so we've talked a lot about contributing and getting money into the IRA and funding these retirement plans. Well, let's talk about the fun part. And honestly, I think that we kind of have this similar experience. It's getting people to shift from the accumulation mindset to the distribution mindset is probably one of the toughest challenges that we face.
Absolutely.
You get into that savings mind, and that's not a bad place to be.
No.
But what we're talking about here is this is where you actually get to start enjoying, the fruits of your labor for all those years, and really being able to take that and spend it.
The sad part about it, I think probably 50 to 60% of the people that do retire are forced to retire. And then that's when they realize they can retire or it's okay. A lot of times when we sit with people, that's the question they ask, can I retire? And, after looking over assets, in a lot of cases we'll say yes, but yet we still have clients that will stick on until either they'll let go or they might go another 3-4 years themselves and then step down. It's pretty wild to watch. Yeah,
it is. And, the nature of retirement has changed a good bit too. And I think we talked about this in the podcast. I know that I think we both have pretty similar mindsets in terms of what retirement's going to look like. And I was actually just speaking with a member today about this, that the concept of working until 65, informing your employer, hey, that's it for me. I put my however many years in. They have a party for you. They give you a gold watch. Yep. You put the keys in the ignition, drive out of the parking lot, and never engage in gainful employment again. That's not as prevalent nowadays. What do you think about that?
No, I agree. It's definitely more by the wayside with the rising cost of everything. When you're looking at that going up 3 to 5% a year in cost of goods, inflation is the one thing that definitely makes people go back to work, whether they can't afford the insurance cost in retirement, which can be pretty expensive, or it's just they're looking to keep themselves busy. It's sort of funny to watch sometimes. We have a lot of people not only going back to work for benefits, but a lot of people going back to work because they enjoy the camaraderie. Because when you retire, you're sort of losing some of your family. That work family you spend more time with than your own.
Yeah, that's one of those things. It's kind of the soft skills that that you talk about that some people just don't think about. I know back whenever I first started in this business, back whenever Moby was a minnow or whatever thing that we want to talk about there, we would do these workshops, and one of the activities in there was you give somebody a blank calendar and say, here, fill this out. What is retirement going to look like to you? And of course the guys would take it, write golf in big letters all the way across it. Not realistic.
Not anymore. It's pretty expensive anyways. Holy cow.
It takes too long too.
Yeah, well,
But and I'm not very good at it. But anyway, all that being said, it's just not. There are some that play multiple days a week, and I you understand that. However, you have to have some other interests outside of that, and I think that's really the key to really kind of thinking about what your retirement's going to look like and anticipating that.
Well, it's funny because we talk about that, right? We talk about setting up a plan for the budget. It's the same thing in retirement. It's setting up your budget in retirement. It's going to be totally different now. think about it. The day of the week that you spend the most money is usually on the weekends, right? Saturday, Sunday. Every day in retirement's a weekend. So that's something to keep in mind. That's one thing that, definitely sitting down with a professional can assist with as well.
Yeah. And that's really kind of, again, when you talk about planning, and going into that and sitting down with somebody and be able to walk through, those
what your
things to think
like.
of what it's going to look like.
Yeah.
Have another question in terms of in actual investments. What are your thoughts about Acorn investments?
Acorn investments.
So Acorn is one of those fractional kind of things that are out there now. And I think it's an app, if memory serves correct.
There's a lot of different sites out there. There's a lot of different things. Not saying they're all bad or all good. The biggest thing you could do is probably research anything that's more so newer out on the market. You'd probably want to give it a little time to see if it's going to stick. You never want to get into something too soon. At the same time, people have said that if we don't get in soon enough, we don't see the upside of it either. So I guess it would be by a case by case basis, based off how you feel on what risk you want to take.
Yeah, I mean, and you think about the whole concept with Acorn is taking kind of your spare change and rounding things up. It's not a bad thing to do. I mean, if it's 36, 64, 70 something cents that you're not going to miss, right, then by all means, I mean, it's better to have it saved than to not do anything at all. And if that's an easy way to kind of jumpstart and kickstart that, then by all means, I think that makes a lot of sense. So with that, let's kind of jump back in a little bit and talk about distributions and looking at it. In terms of, we talked about traditional IRAs, that the big difference between the traditional and the Roth is that the traditional, when the money comes out, you pay tax.
Yep.
And again, we still got that 10% penalty tax, going back to our earlier audience poll question there, that you get that additional 10% penalty tax if you take money out prior to 59.5.
This slide's a little outdated as well. Obviously on the traditional now, the RMDs now begin at 72 instead of 70.5. Deadline for taking the first RMD, I'm sure, still going to probably remain the same, April 1st of your first drawing year. But just keep in mind, you still have to pull the other amount that same year.
Yeah, it's outdated in that sense. Now, keeping in mind, though, that if you turned 70.5 last year,
yes,
you still have to take it.
You have to take it.
So
sorry, guys.
You're not grandfathered. It's that one still happens. Yeah. So yeah, if you're in that 70 to 72 range, we need to talk. Make sure that we've got an appropriate strategy there. But still, keeping in mind that again, this is another big difference between the Roth and the traditional.
Absolutely.
The Roth doesn't have an RMD. Because there's no taxation on your distribution anyway.
Correct. You've already paid taxes.
So government's already gotten their money. So that's kind of what we're looking at there. And then kind of moving forward, and looking at the difference between a traditional and a Roth, just kind of doing some comparison. When people use a traditional versus when we're using a Roth. We're looking at it, you might choose a traditional IRA. Again, talking about if you're within 5 years of retirement, again, I don't necessarily.
Yeah, at this point, it probably wouldn't make as much difference. But I mean, I'd say probably 10 years or longer definitely could make a difference. Lot can happen. I mean, most times, if you're really looking at a rule of 72, if your average return is 7%, you should be able to double money in 10 years. So there's an opportunity there.
Yeah, I mean, really, of these points, I think number 2 is really the one that I would advocate for.
Absolutely.
If you know that your retirement income is going to be low, if your tax bracket's going to be lower in retirement, then it would make sense to use a traditional.
Absolutely.
And so that you would want to do that. The rest of them, like I said, I think kind of the conventional wisdom on this has shifted a little bit nowadays to where that's not necessarily the case. Looking at it, this obviously, when we talked about some of these points before, about it's never too late. There's definitely things that we can do there. We've got some other questions from the floor. This one is, I'm a teacher, so I have retirement funds with TIAA from Valencia. It's woefully small, but is it something worth investing in an IRA?
Absolutely. Again, it might be good where it's at, depending on what options you have available. And if it's been good customer service and the returns have been okay, that could be something too to talk about. But yeah, by all means, that's what Rob and I really specialize in, to be able to sit down and talk about things like that, to see really where you're looking to go, get an idea of what you're trying to do. And there we could definitely give you some really good advice.
Another question is, what are our thoughts on life insurance index policies for kids? that build cash surrender values, would this be a great way to start your kids off with savings and investing?
Anything you could do for your kids, that included, would be great. And not only that, trying to teach them that sort of financial literacy early. Whether it's chores and you're paying for them, and where the money goes and how it's saved and where it comes from. My stepdaughter thinks that the cash card is just always full, and that's just the way it works sometimes. But in reality, we all know the importance of, at this point, I would hope, especially closer to retirement, savings. The key is starting, like Rob said, and again, we'll hit this on the head again. It's all starting early. Start as early as you can. So, yeah, I would say absolutely.
Yeah, and it starts the conversation. Yep. It's definitely a way to kind of build that interest in it a little bit. Provide some insurance coverage, for at some point in time later on in life. Everybody has their different thoughts on insurance, obviously, but if you're doing it on a child, the cost of insurance is fairly low. It's funny. I actually had a member I was meeting with the other day who actually brought in their, dad had bought her $1,000 face value life insurance contract way back in, the 60s. That policy now is worth way more than $1,000. I mean, just the cash value from it alone. Insurance as an investment, it does have its place in some cases. Now, are there cheaper ways to do it sometimes? Absolutely. But again, so, don't want to make any kind of broad, statements there on that. But again, if it's the choice between doing that and doing nothing at all,
we'll do that.
Yeah.
It really just comes down to starting as soon as possible. And at the same time, even if you didn't start and got a late start, I didn't really get started until I got into the industry. I got in the industry back in 2005. And I think that's when I realized that, even though I was always making good money and I always thought I'd be making good money, that I didn't realize the value of savings as much as I should have. So thank God I got into this field. It sort of helped me out. But boy, if I would have started back in the day, I might not be talking right now. I might be on the beach sipping some Mai Tais.
So you mean you wouldn't be sitting here next to me right now?
Well, I'd bring you with me, Rob.
Oh, okay. So I have a couple more questions here, John.
Man, you guys are flooding it.
We're not going to put you into the lightning round yet, but okay. You're getting pretty close. All right. So we have one question from the floor again. We talked earlier about the $19,500 limit. Is that in aggregate with the IRA limits, or is that separate from?
That's separate from. So the $19,500 for anybody under 50, that's the max contribution you can make to an employer's plan. If you're over the age of 50, you can do an additional $6,500 to bring it to $26,000 total per year. So what that really ends up being is the government will allow them to pull up to 25% of your pay, or if you're, again, over 50, $26,000, whatever's less. The IRA is definitely separate, so that's a whole different animal.
Yeah, and that's when you get into kind of those limits in terms of, if you're able to contribute or not, because sometimes you do have the phase out on the IRA side. The best answer that I would say there would be to sit down with somebody and really kind of walk through your individual situation, because there's a number of moving parts in there that could affect it. But for the most part, no, there's the IRA limit, and then there's the 401k limit.
Correct. Good question.
Yeah. Another question we have is, you're looking at, many 401k plans offer a loan provision. And so being able to kind of walk through the difference between a 401k loan versus an early withdrawal, what that looks like.
When it comes into the loan aspect of it, again, depending on what it's for, I always tell people if they can afford the payments of what they're doing, don't take the money out. Just keep it invested. At the same time, we know that's not realistic for everyone. So pulling it from a 401k, you do pay it back with interest. I think the average payment interest-wise is about 5%, give or take. But you can pay it with payments over time that you take the loan. So I believe if it's for purchase of a home, you actually have, I think in some cases, up to 20 or 30 years I think it's 15 years to pay it back.
Yeah, I think it depends. Yeah, and for most personal loans,
most personal loans is going to be max 5, I'd say.
Max,
so
60 months.
Depending on where you want your payment to be, that's sort of how you'd structure that. But keep in mind, when you pull that money out, it's not earning anything for you. So it's sort of the double whammy. Not only are you paying interest on money that's not earning anything for you, but now that money's been taken away from possible retirement, aspect later on.
Yeah. And one thing that we didn't really touch on before, thinking about it too, when we're talking about this topic, is that, there are some exceptions to that 10% penalty that comes into play that we talked about. Obviously first time is an exception. Things like college education up to a certain amount. A new thing with the Secure Act was adoption expenses, are able to be taken from retirement accounts without incurring the penalty tax. Medical expenses for immediate family, disability, things like that. The big things in life, we can get actually an exception from that 10% penalty tax. But so there are some ways to do that there. I would say, again, it's probably a good idea to sit and really kind of go through your individual situation. Kind of tying along with that, another question, is there interest about you're talking about the interest part. So is that interest from a 401k loan? I'm sorry.
Every 401k that you borrow from is going to have some sort of interest tied to it when you pay it back. So those payments are with interest. And that's an annual percentage rate that you'll pay back.
Yeah, I'm sorry. That question actually was, is that interest your interest from a 401k loan? So.
Yes. Well, actually, again, when you pull money out, it's not working for you anymore. And the fact that you're paying interest on that, so not only are you losing at, let's say you take $10,000, that $10,000 is no longer making maybe an average of 7-8%, and you're paying 5% on it. So if you really look at it from the rough side, and again, not that I want to beat this down, it's much better if you can afford the payments not to take from it. But if you need to, you just have to keep that in mind.
But yes, I mean, the interest that you're paying on it, you keep it. Somebody else isn't keeping it.
No, absolutely.
But it's basically
it goes back.
You're shifting your money from your after-tax paycheck back into your 401k to pay back a loan there. So it technically is your money still, but it was your money to begin with. Correct. So we need to be careful about that. So we talk about another question is nowadays that there's people tend to switch jobs a good bit. And then you have an old, 401k plan or 403b plan. Any tips that we have in terms of rollovers and what to do with those?
Well, obviously a rollover is an option. Rolling over to the new employer plan is an option as well. I think what happens, I've had it sort of double-sided, 6 in one hand, half dozen in the other, where people don't mind having 5 different accounts out there because not all employers will make you take it. And if you're happy with the service and happy with the returns, then I suppose it's not an issue. But I think in a convenience standpoint and time standpoint, which is the most valuable thing we have, I think consolidating things into 1 or 2 plans is probably the better way to go.
Yeah. Now, and I agree. And again, you've heard me reference administrative simplicity. It's one of those that I do believe in it a good bit because you get the kind of the one joke of, I'm diversified. I've got money with 3 different people. Well, you might have it with 3 different people, but if you gave 3 different people the same kind of answers, you're probably going to have 3 allocations almost the same. You really haven't diversified anything at that point in time.
The funniest thing I ever heard about that when it comes to diversification, a lot of people say, well, you don't want to put all your eggs in one basket. Well, I agree. You definitely do not want to have all your eggs in one basket. I'm pretty sure you want all your chickens on the same farm. So
now we went to the agriculture route, so this is good. Another question we have, any thoughts on stash? And actually, I think I'm probably more familiar with this one than you are. But no, it's another one of those apps, another one of ways of getting that saving habit built up. I think they even have the debit card that gives you stock back or something along that line. Again, not a bad approach. Now, is it the end all be all that you want all your money in stash? Probably not. But I don't think it was really ever, kind of intended for that. I think you can get started with as little as $5, within there. So, kind of going back again to one of those earlier questions of, is there a minimum? No, I mean, look, you've got this option right there that you can do for $5. That's not a bad way to get that habit going.
Yeah, I think the only bad thing is if you don't do anything. That's pretty much what I think what we've come to today.
I think we've said that a time or two.
Yeah, I'd have to say.
Any thoughts on annuities?
It's funny because I know when I first got into this industry, I had to watch some footage of somebody who can't stand annuities. I don't know if anybody's ever heard of Susie Orman. So if you're a Susie Orman fan, I mean, that annuities are bad. They will do damage. Nobody likes them, and they're just awful. I'm going to say I'd have to agree with her for some people, but for some people, I'd have to say absolutely not. They definitely could fit, whatever their plan might be. I think when you're looking to put a puzzle together, sometimes you need different pieces. And the older we get, when we get closer to retirement, you think about starting a jigsaw puzzle. Sometimes a piece will fit in a spot where it shouldn't fit. And when you get closer to the end of the puzzle, you realize that piece needs to be moved. When you get to the end of that puzzle, you need specific pieces. So annuities are bad and annuities are good. I guess that would be my answer. It just really depends on what you're trying to do. I'd say the bad annuities are the ones that are sold for the wrong reasons, or people don't have the time. People didn't realize what the fee structure was, things like that. Annuities are good when they're sold properly and explained properly to where you can sort of understand it the way we do.
Yeah, it's one of those. I think that you can almost do that with any investment product out there. That if you start, if all you have is a hammer, then everything looks like a nail. So you can misuse anything, any product, and the annuity side. Yeah, there's a lot of talk around the fees. However, it's also explaining what those fees are going toward, and if those fees make sense, then that's one thing.
Well, not all annuities have fees either. And the thing you have to keep in mind, I know I've seen plenty of studies on this, is that in retirement, if you have 25% of your assets, I think in a plan of retirement that's on the conservative side, if you're too conservative, you're not going to get to the full retirement goal or getting enough income in retirement. I think by having 25% of your assets into annuities, it actually steps you up to 67% of chances of hitting your goal. If you have 50% of your assets into annuities, it can actually trigger you to get up to about 87% of goal. So they are a huge part in some places of keeping money safer, but at the same time still giving you opportunity for growth.
Yeah, and like you said, I think it depends on the individual situation.
It is an individual situation, definitely.
So yes, in some cases, like you said, they're bad. In some cases, they don't fit. In some cases, they work very well. Yep. So it just depends on the individual. So with that being said, got one question. How do you figure out how much money you need to retire if you have 20 more years before you're going to retire?
How do you want to live in retirement? We know that inflation is 3 to 5% a year, so cost of goods are going to go up. So if you're 20 years away, I'm sorry to say that you're looking at roughly that increase with the cost of living going up. That being said, there's plenty of people that I have a client I met with today that they live very frugally. They spend $800 a month on all their bills, all their debts paid off, and they have a couple $1 million. Somebody like that, they're never going to go out of their money. They're never going to run out unless they have an extreme terminal illness health case where they're stretched out over years. But that being said, it really is how you want to live in retirement. Keep in mind, this is when we talked about budgeting at the beginning and being realistic. I'd say you have to be realistic in retirement too. If you really want to travel the world, then you have to make that as part of your plan going forward for the next 20 years to save for that.
Yeah, and I think that the biggest thing to really keep in mind there too is putting that plan down either on paper or in some format where you've actually put some thought into what are these goals, what and I know that's what one of the tools that I use a lot. It allows us to really kind of go around with retirement being very central to that kind of the retirement need, but then we can model for things like I want travel or buying a vacation home or buying a new car, or we can model all those things in there. It just depends on, we have to have the data to be able to do that and the thought that's gone in behind that as well too.
Well, it's like on the podcast too, Rob talked about the retirement stool, having the 3 or 4 legs to the stool. Social Security, pensions are 1 or 2 legs. Then we look at retirement. Retirement's a huge piece. I want to say it covers about 40-50% of what you're going to need in retirement. So back in the day, like Rob said, back in the day when they gave you the gold watch and the pensions and you never had to worry about working another day, you were good. Today's day and age is a little bit different. So
yeah. And so the last question from the floor, and of course I have to, I set this one up. I held this one back, so I'll own up to that. But can I stop by Addition Financial to open an IRA or a Roth IRA?
You absolutely can. It's always a good place to start is sitting down with one of the MSRs. They're very well versed in what the options are here. If you're just starting out, that's probably the best place you could start. Once you get some funds saved up, or if you have an IRA that already has a balance in it, at that point, and you have your reserves saved, your emergency funds, then it might benefit you to sit down with Rob or I to really talk about what might be out there for you.
Yeah, absolutely. And so, yeah, obviously, like John said, I think, it's, we the membership, we believe in education here, in financial education, which is, the reason for, these webinars, for the podcast, for, trying to make a lot of this information be able to cut through some of the clutter, a lot more accessible. I know I met with a member yesterday who has come into some funds and has gotten themselves just totally just confused. And she even came in and admitted that I'm just confused. I've talked to so many different people, and you talk to so many different people and you hear so many different answers. And then sometimes you have to really, focus on, what's the angle, I guess, of where it's coming from. I joked about the hammer and the nail thing before. And, that kind of came from the fact that, if you are going to somebody who all they can sell is one thing, well, guess what? If they can do the best plan in the world for you, but ultimately I can almost guarantee that the solution is going to involve the thing that they can do. Which is the nice thing about, within, I think, in addition with the arrangement that we have, is that, we are agnostic to whatever solution it might be. I mean, the end goal that we're really going for here is making sure that our members are taken care of.
Yeah, we definitely work for an organization that offers full services, which enables us to go ahead and touch any step that you want to touch. What it really comes down to is what you specifically. We work as fiduciaries. That's a law that was passed in 2015 that required it just on retirement funds. But I know Rob and I, and working for CUNA, since we do work for a conservative firm that works with a conservative partnership with the credit union, we're fiduciary across the board. So our goal is to make sure we do what's best for you. And no matter what we suggest for a strategy, you're in charge. You're the boss. You're the ones that get to decide whether you move forward or not.
Yeah, and I tell my members that all the time too. It's, my job is not to tell you what to do. Yep. My job is to take kind of what you're telling me and what your goals and aspirations are. Put them together kind of into a cohesive plan, and then be able to tell you the what ifs off of that. Okay, well, that's great. Well, if we do that, then it's going to affect you in this way, either positive or negatively.
Exactly.
And then just making sure that you understand the ramifications for it, looking at it and making sure that every dollar that you're using is working the hardest for you. And if there's a way that we can kind of maximize the value to that dollar that's saved or that dollar that's invested, I mean, obviously we want to do that.
Well said.
That being said, I think we're out of questions, and I think we're out of time too. I think we actually ran a little over, but
apologize for the late.
I appreciate that.
Thank you, John and Rob. This concludes our presentation tonight. Check your inboxes for an email containing a link to tonight's recording, and thank you all again for joining us.